My name is Matej Rostka. I'm a reporter on Politico's financial news desk, and I would like to welcome you to this panel discussion about the role played by financial services in the COVID crisis and the subsequent recovery, and particularly in the first phases of the crisis, we all know the banks found themselves in a pretty unfamiliar position, namely to be praised for what they did and to be cast in the role of the good characters. But our distinguished panel here will try to look at anything that might have gone wrong and also what the difficulties in the planned recovery might be for the banking sector. We have John Berrigan from the Commission's Financial Services Department. We have Anna Boata from Euler Hermes. She's a macroeconomic researcher. And Andrej Kovarik, a member of the European Parliament. And also, please look at the Swap Cards app and the live poll that we posted there. And if you would like to tweet, if you don't mind using the hashtag PoliticoFS, but 1F, please. Now let's start with the questions. I would like to ask John first, if he could tell us a little bit about the conclusions he's drawn from the financial aspect of the COVID crisis, and particularly the March meltdown in markets, and what potential changes might be made to avoid something like that happen again. Thank you, John.
Well, thanks very much, and thank you for the invitation to speak today. I think what you referred to as the market meltdown in March was, of course, an inevitable consequence of the markets adjusting to what was an enormous economic shock, a real economic shock, which came with the lockdowns to the abrupt lockdowns in response to the COVID pandemic. I think my overall assessment is that although there was this period of turbulence, as you mentioned yourself from the banking side, in general, the financial markets held up rather well in this crisis. It did require a response in March, particularly on the market side. But if you look back over the last period now, it's a year, the markets and the financial system in general have held up pretty well. So I think the lesson we draw from that is that the work we did, the reforms we put in place following the great financial crisis of 2008, 2010 paid off. And indeed, the financial sector was a positive contribution to the response to the crisis this time, and not a multiplier of that crisis, and indeed the originator of the crisis as it was last time. The other lesson we learned, and which put us in good stead, I think, this time, was that coordination is key, and coordination among policymakers is key. And I think in general, I would say that the level of coordination globally, but also within the European Union among financial regulators and financial supervisors was pretty good this time. You know, it was a kind of multi policy response. We had the central bank providing liquidity into the system, supporting markets, but also providing liquidity to banks. We had governments, you know, relaxing some of their fiscal rules, relaxing the state aid rules, allowing them to inject money into the economy. And then, of course, the banks played their part, and regulators assisted the banks in playing their part by facilitating their capacity to lend into the economy. So, you know, all in all, I think the financial sector response this time to what is an essentially economic shock has been quite good. What lessons have we learned? I think there are two lessons we've learned. One is around liquidity of markets. So one of the issues which drove this meltdown, as you said, was that certain markets have become more illiquid over time. And there was an issue about liquidity of those markets in stress. And I think we need to look at that and draw the right lessons and not the wrong lessons. So there are issues around certain segments of the non-bank intermediating sectors of the economy, notably money market funds. And there's an international response to that. The Financial Stability Board is looking into how money market funds, I have to be honest, more on the US side and on the European side, but nevertheless, the money market fund space is being looked at to see why it was that the Fed needed to intervene so aggressively during that period, and whether there's an issue of structural liquidity issue there. So that's a lesson we will look at. We will see what we learned there. One lesson I would not like to draw, of course, is that this is an issue around the inability of banks to make markets, and that this is somehow a problem that has been created by the previous reform. We know that banks holding large amounts of illiquid securities was in fact a problem for the banking system in the last reform. And one of the objectives of the reform was to reduce bank exposure to those securities. So I don't think a good lesson to draw would be for us to start reversing reforms of 2008, 2009. So we are looking at lessons. I think we will draw the ones that are necessary. But overall, I think we can be reasonably happy that the financial sector responded well.
Right, thank you. Anna, I think you might have a slightly different perspective here, particularly regarding how there might be some issues around restructuring of COVID-related loans to business. So why don't you tell us a little bit about that, please?
Yeah, it's a true point, the fact that we are now very dependent on state support. So while we have managed to avoid solvency risks and liquidity risks with unprecedented support in terms of central bank liquidity or state support, we have also made like a drug, and we are now addicted, the private sector is addicted to this support, and the banks in particular. We see that the banks have tightened credit conditions since since Q4 2020, and that's certainly a worry. And if we take a step back and we look at the UK as one of the countries being the head of the curve in trying to normalize after this unprecedented support, we see that there's no exit door for the moment, and they are forced to transform the COVID-19 loans into what they call recovery loans with the same state guarantees, 80%. So what does it mean? It means that the banks, even if they are not really happy with the low profitability that they do make on these loans, they are certainly happy to have the 80% state guarantees, because we know that credit risk is there. And we know it's just a question of time to understand which companies have been viable and which have not been viable, because we didn't manage to distinguish. We have given everything to everybody, but we don't know now what's the true share of zombie companies. And in that respect, of course, if we want to avoid a liquidity shock, and if we want to manage let's say a progressive phasing out from the state support, we clearly need to pay attention on these state loans, on the COVID loans, because we know that today there is excess cash. We know that the debt coverage for companies, thanks to this additional liquidity, has improved. But in some countries, we are at low levels. If we take the case of France, for example, the deposits of the non-financial corporates cover only 20% of the total debt. But if we take the case of the UK, we are rather at 36%. So that's clearly something for me that could be a drag on the recovery. We have seen that the governments have been smart enough to increase the grace periods of these loans and to increase the maturity of these loans. But I think the question would go beyond 2021 and 2022 if we really want to avoid any cash flow issues for the companies. We really need to make sure that with this cash, companies can invest, create jobs, and really contribute to the recovery. We really need to make sure that this doesn't become a hurdle to the exit of the pandemic and to the recovery.
Thank you. Mr. Kovarik, as a lawmaker, I'm sure you have some thoughts about when the tapering of the support should come, and what sectors or what areas of the economy should start to be weaned off the support first. But also, do you think there should be more targeted support through the banks in order to to shape the recovery in a way to influence some areas of the economy over others. How do you see that situation?
Thank you, and good morning. Thank you for the invitation. I think very, very relevant questions, and I would agree here with the previous speakers on first. I think the important role that the financial sector and the banking sector has to play, and actually already had to play since the beginning of the pandemic, and that's one thing. And the other point, a very important one, is actually I think we have to really now have a clear outlook how we do manage the recovery phase. Exactly in the terms as Anna mentioned, we are currently running the economy mostly on government support or state fiscal stimuluses. But we have to see the transformation process on coming from, let's say, the granting or the guaranteeing systems towards more market-based and more, let's say, the normal way of doing ways of financing. And this is an important point. And I think as legislators, but also as not only in the EU level, but also on the level of member states, which have a very important role to play. This is actually something that has to be the cornerstone of our considerations. I think on the EU level, we have a number of tools in this regard. I think we have some let's say, initiatives such as the Enhanced Capital Markets Union project, which can actually help us in this task. But you mentioned some more specific or targeted support, and I think this could be also a way out, because we can see that when we look at the countries and we look at the economic sectors, some of them are more vulnerable to the risks that are created by the pandemic, and we're talking here about obviously the services sector, the tourism sectors terribly impact, and some of them are more resilient to those shocks. For example, the manufacturing industry to a certain extent. So I think the key here is to see and to have also coordination on the EU level when it comes to, let's say, the regular sanitary restrictions and the responses to spread of the virus on one hand, and then to combine it with the targeted support, namely to those sectors which are affected the most, which are hit the hardest, and where, for example, the perspective of coming back to normal is much more complicated than for some others.
Right. Thank you for that. Now, back to Mr. Berrigan. It does seem like state support is here to stay for a while, even if it's going to be targeted, and that means you need healthy banks to keep pumping the money in a way that agrees with the policy of the day. Now, that means dealing with the bad loans, and there is a lot of concern about what would happen when the bad loans start piling up. That's the subject of our poll for the audience today as well. So I was wondering, is this one of the issues that the Commission is worried about, and what potential solutions are you exploring? Thank you.
Thanks. From the very beginning, it's a year ago now since we started talking about this, we kind of saw the crisis as having two parts, a liquidity phase and a solvency phase. The liquidity phase, if we're honest, has lasted a lot longer than we expected. And the solvency phase, in many respects, has not even arisen yet. And this refers back to some of the issues that Anna has referred to. So we know that, when this more acute phase, this liquidity phase of the crisis ends, we are going, and the support measures are withdrawn, and they should be withdrawn gradually. But as they are gradually withdrawn, we do in fact expect to see a rise in insolvencies, as Anna has mentioned. And of course, the longer this phase, this acute phase has gone on, the greater the risk that this wave of insolvencies will be greater. And that wave of insolvencies, to the extent it's not guaranteed by governments, for example, will have important implications for the quality of bank balance sheets, which then by extension will have implications for their capacity to lend. So we have to do something. We're at this very delicate moment now where we're asking banks to lend, but we're asking them to lend in a way that is more discriminating. And this is why I'm not so worried by the banks' tightening of lending standards, but this is a natural response to banks becoming more discriminating between those borrowers that they think are viable long-term and they're not. But we need them to keep lending, even if standards tighten somewhat, they need to continue lending into the recovery. That means we have to prepare for this wave of insolvencies and the possible implications in terms of non-performing loans. And in the Commission, as you know, last year, we put out a communication on non-performing loans, which essentially deals with the ecosystem for managing those loans. So it helps to build secondary markets, works on data, talks about AMCs, all ways in which banks can have an environment in which they can manage non-performing loans more efficiently. It doesn't, of course, affect the fact that banks will need capital to manage those non-performing loans. But I suppose the most important most important objective in issuing this communication when we did was actually to learn another lesson from the global financial crisis of 2008 and 2009, and that is that you have to get out in front of this problem. If you don't address non-performing loans up front and you delay too long, then you are very quickly behind that problem. And the honest reality is we're still dealing with some of the non-performing loan issues of the last crisis still today. And so our message was to the banks and to the governments to begin to prepare for what is a wave of insolvencies that are coming, get out in front of the problems and prepare the kind of environment for your banks to manage that more effectively. And if you do that, then I think we should be able to strike this balance between ensuring the stability of the banks and therefore ensuring their capacity to lend into the recovery.
Understood. Now, Anna, Mr. Bergen seems to be suggesting that it's the job of each country to control or to regulate how the bad loans are being dealt with. But I wonder if you might think there's a role for the central authorities of the EU as well, and what policy should they have on this?
Yeah, certainly the fact that the EBA has changed, so the European Banking Authority has changed the rules on loan provisioning is a good news, because it means that the banks are not so stretched in terms of capital and they can continue to lend. And on the other side, I think the fact that the central banks, or the ECB in this case, will continue its quantitative easing program until 2023, even beyond that, 2024, it's a good news for liquidity in general. So I think we should continue to stay into this accommodative environment. But the problem is that this environment is currently tested at the global level, be it in the US or in Europe. If we look at the, let's say, inflationary, but economists like to call it reflationary environment. And clearly the markets are testing the credibility of central banks to deal with the recent rise in bond yields. So clearly we are in a bit what we can call a bumpy normalization ahead, because it won't be easy for central banks to keep on proving their credibility and proving that they will not be late in normalizing, and that indeed reflation is not inflation. But also for the governments. Again, I think that the banks are very comfortable in giving loans under the state guarantees, because clearly for them, it's less of an issue. But for that, we need to change some of the rules also at the national level. If we take the case of France, for example, it's great to have 300 billion euro of state guaranteed loans. The take-up has been 130 billion. But actually, in practice, very few companies can still take that, because it's a limit in terms of 3 months of turnover. So it's good to have it like a stabilizer, theoretical stabilizers, but it doesn't really work for now. So there are countries which are thinking about changing that. Again, the UK is ahead of the curve. Germany too. So I think it's something that needs to go hand in hand at the European level, at the national level, because we know that fears of credit crunch are not understated. Again, we have seen that credit conditions have tightened not only for companies, but also for households. And this is something that will continue to happen, of course, and also the search for profitability of the banks, because they have now been in more than 10 years of very low interest rate environment, and they are looking for reasons to increase a bit the interest rates. And we see that even if it's very, very progressive. So again, for me, I think it's clearly a question of coordination at the European level and at the national level. And I think it's also a question of recovery, because if you have a sustained and strong recovery after the pandemic, then the solvency risk could be reabsorbed or could diminish a bit. And also it could be obviously an absorber of heterogeneity that we see currently between sectors. We now have a two-speed economy in a sense between manufacturing and construction and the COVID-19 services sector. But the problem is that we are now still heading towards this divergent recovery, into a multi-speed recovery. If we take the case of Europe, again, we seem to be a bit the losers in this story. If we look at vaccination, we are certainly too late. And unfortunately, since the start of February, when the worries have started to point out that, hey, we have 5 weeks of delay in terms of vaccination, if we really want to open after summer, if we really want to vaccinate 70% of the adult population. And since then, we gain 1 more week of delay. And in some countries, we are even 7 weeks of delay, Netherlands, Belgium. So that's clearly for me of a concern, because it also shows that we will exit the pandemic not at the same speed. And that could mean actually 2 points of growth lower. So if we talk about 4% growth in the Eurozone this year, we could actually talk about 2%. And if you compare that with China, 8%, if you compare that with the US, almost 5%, we clearly, again, look a bit late. And if we don't have this recovery, then we can talk a bit about more NPLs. So that's clearly, for me, something that needs to go hand in hand. Recovery, a sustained recovery, but also coordination in order to reduce the regulatory hurdles on the banks and allow them to lend. Yeah.
Thank you. I thought that was a fascinating parallel between the vaccination and the recovery and the stability of the financial system. I wonder if we will be asking ourselves pretty soon whether the vaccine is also an issue of financial stability. And I wonder, beyond that, and in general, this crisis has been very damaging for smaller countries as well. And I would like to bring Mr. Kovarik in to discuss how things are looking in the Czech Republic and what the future holds, what the main issues for the future are in the Czech Republic, and what the challenges for the banking system might be, and how the policymakers should deal with them.
Well, the situation in the Czech Republic currently is worsening, and it's not actually very optimistic, and we have I think at this point very hard government restrictions on mobility, on economy, many sectors closed, schools closed, etc. etc. So I think we are at the very hardest stage of the pandemic, and obviously it has quite a significant impact on the economy as a whole. But as I said earlier, obviously there are some factors that play into overall performance of the economy, and it has to be said that from the economic point of view, we have quite well-balanced and resilient economy. We have a well-functioning banking sector. There's still a lot of liquidity in the banks, and also banks are ready to provide state-guaranteed loans to basically to the extent as Anna mentioned in the case of France. Also, there is a very high level of the contribution from the industry, especially manufacturing industries such as automotive, etc., which is actually a huge part of the economy and is still running. So these are, I think, the key, let's say, factors where the economy is still working quite fine, and also when we look at the public finances, quite low level of public debt, etc. So I think in general, the conditions are there, but as it has been mentioned earlier, the longer these restrictions and the pandemic takes, the harder the recovery phase will be. And I think it's the same for basically all the countries across the European Union. You mentioned, I think you made a quite interesting point in saying where the vaccination can become a factor of financial stability. And to a certain extent, it seems to be the case. Obviously, we have to have a sort of optimistic outlook, and we have to have clear milestones and ways out of the pandemic, which the vaccination is a huge part of it, together with testing abilities, together with the cooperation among the European countries when it comes to mobility, the performance of supply chains, etc., etc. So I think those are very important points to raise, and those should be again looked into very closely also by European leaders when discussing the recovery phase.
Thank you. And now to our final question, and I would like to respectfully ask you to keep your answers slightly briefer than before because we have 7 minutes left. So, Mr. Berrigan, the recovery has been unequal, and the effects of the crisis to begin with have been unequal on European countries. And now the vaccination campaign is also unequal. We see Denmark doing quite well, other countries doing a lot worse. And I wonder how would the Commission deal with a situation where you have lockdowns and terrible economic losses and losses of life, of course, in some countries, while other countries are beginning to unlock and the economy is beginning to move again. This could pose a serious long-term problem for the financial services sector, of course, but for the greater economy of the EU. So what do you think about that?
Well, just to be brief here, I mean, I think the Commission has recognized from the beginning that the impact of the COVID shock will be differentiated across member states. That was from the very outset. And as you mentioned, there are sort of differences in the short term, i.e. the actual experience of the crisis itself is different. So we're having different paces of entering the crisis, different paces of vaccination, all of these things which are affecting the actual experience. So different countries are experiencing the crisis differently. But also, I think as was mentioned before, the longer term effects of the crisis will be different across member states, depending on the sort of economic structure, the composition of the economies in these member states, with some member states more affected because they are more dependent on those sectors which are more likely to be more durably impacted by the crisis. So we have, there are some things we can manage here through coordination, as has been mentioned, but some of these longer term effects due to the composition of the economies are more difficult to manage just through coordination. And that's largely the rationale behind the Next Generation EU and the Recovery and Resilience Fund that we have put in place, was a recognition of the fact that different member states are going to experience the short and indeed the longer term effects of this crisis. And that's why we wanted to put in place an instrument that works at the EU level and tries, not completely, but to a good extent, to level out these differences of experience, both short, but particularly long term, in the effects of the crisis. So there's no magic solution, I have to say. Countries are different, economies are structured differently. But we believe that this EU layer of borrowing and then spending is very important for countering some of these different distributional effects of the COVID crisis.
Thank you. Anna, now over to you. If I may spin the question a little bit and ask about the inequality of the recovery. What risks do you see for the banks and the financial sector stemming out of this?
Well, for the banks in particular, of course, the structure of the economy would be key, because the strength of the rise in insolvencies would not be the same across countries. Generally speaking, we have between 20 and 25% of companies or of total turnover which are in the COVID-19 sector. So clearly that's something that differs from one country to another, with France, Italy, Spain, Portugal being more hit than Eastern European countries or Germany. And clearly that would be a key game changer, depending on what the states are going to do in order to still save these sectors. We hear from France that they are willing to do whatever it takes to save all the companies. The UK is going a bit in the same direction, but it's not a EU coordinated approach. And I just wanted to stress on the EU Generation Fund. I think that's clearly something that would be a game changer in 2021. And that's clearly something that was positive, because for once, we managed to coordinate at a wider scale to put something big together. But the problem is that, again, it's a bit too bureaucratic and a bit badly constructed because it's project-based. And for now, we see that countries, even countries like Germany, are struggling to find the projects. So there is a risk that actually this financing remains theoretical and not given to the countries. And I'm wondering how we can change that, and how, if we really want to change the structure of our economies, be more competitive and attract some of the reshoring or nearshoring, because we have done a survey in 5 European countries and we see that 30%, almost 1/3 of the companies would like to nearshore. So in Europe, let's say, in the European Union. So what can we do with this Next Generation EU Fund? Can we use it also for some tax breaks, super amortization for investment purposes? I think we should think in a wider scale, just to be sure that we don't spend this money, which is a lot of money, if I can say, 750 billion euro, on things that are costly in the short run. Yeah, green transition is great for a long-term perspective, but it's painful in the very short run. So I think there are still some things that we could do in order to make the change after the pandemic of our economic structures and make the economies more resilient to future pandemics at the European level. But I'm confident that we will be agile and change the setup if needed. We will see in April, May.
Right, thank you. Now, Andrei, I think Czechia has something to look forward to when it comes to reshoring of supply chains and investments in this type of restructuring. So do you think the country is looking forward to that? Do you think it's getting ready to expand its economy thanks to this phenomenon? And will the EU funds help do that?
Right. I believe that the recovery and resilience facility and the entire Next Generation EU can be a very helpful tool in this regard, and I think it's really up to the member states to use it in order to, as the name of it is actually alluding to, in order to enhance recovery, but also start building resilience. I think when we look, a couple of years later, when we look back on what happened during the pandemic and the after, we will see some restructuring of economies and between sectors and how they organize. You mentioned the supply chains. I think to a certain extent we can see it already now. So one of the lessons learned from the very beginning of the crisis was reshoring of for example, capacities of building sanitary health material, protection equipment, et cetera, et cetera. Those, for example, are issues that were profiting from those changes. And I think we can see it across Europe. The change between the total lack of the PPEs, back in March or spring 2020, and the situation we are currently now. And I think this is one of the examples of it. But I think what is really key here. It's actually also to use this opportunity in order to enhance some of the internal factors in the economy. And for example, I really believe that the investments in the digitalization in this regard can be those game changers and help the not only the business sectors but also the performance of public sectors to overcome and sort of steer the recovery. So I believe that if those tools are used in the right way, then can make the difference.
Thank you. We have to wrap it up here for now. We're already a minute over time. Thanks very much for everyone who listened. Next up is my editor, John Riga, interviewing the CEO of Generali, Mr. Philippe Donnet. Session begins at 10:25 in the morning. Thanks again to the panelists for the excellent discussion, and wish everyone all the best.